Good morning, everyone. It's great to be here, and it's even better to be continuing the conversation that we heard so much about this morning on the macroeconomic impact on private equity. And I think in order to continue this conversation, what makes this somewhat of a unique panel is we'll get to drill down deeper from a credit perspective, from a co-investment perspective, and from a direct UK lower mid-market perspective. So with that, I know we've got limited time, so let's get started. Mo, let me begin with you. You are a director at finance at North Oak. Thank you for sponsoring
Thank you.
The panel, and you have multiple decades in structured finance. Is it fair to say the last couple of years you've been just a little bit busy? Can you talk to us a little bit about what you're seeing in interest rates? Kind of, they went up, they've come down. You had record refinancing, repricing. Talk to us about what that's been like.
Yeah, it's been a bit of a roller coaster. I think the macro environment has changed so much in the last 3 years, whether it be interest rates, inflation, geopolitical risks, something that we were benign for, call it 10 years, post the GFC. I think interest rates spooked a lot of people because they rose so quickly at a level that was unexpected. So if you were writing a deal in 2020, no one, I think, modeled in 5.25. I just don't think they did, even in their worst case scenario. So when you saw that as reality and people say maybe 6, maybe 7, then it stopped. And then now we've been on a downward trajectory down to 4%, and it's been slower than expected. Everyone was expecting interest rates at this time of year to maybe be 3.5, inflation to be corrected, and it hasn't happened. So therefore it creates portfolio company issues. There's, how do they deal with it? What are the levers? Leverage by definition is cash flow led. And then when more of your cash is used to service or pay interest, that's a problem. So yeah, I mean, it has been busy, but it's also been positive because you have a lot of sensible sponsors out there that aren't always looking for the most leverage. So those companies that actually consciously decided, call it 3-5 years ago, that we like leverage, but we need to be sensible with leverage, and we want headroom in uncertain times, have done really well, actually. And those that have been a lot more aggressive with that have actually struggled. And there's been a challenge around that.
Well, can I just ask another question on that challenge? Because when we, coming out of the second half of 2022, interest rates obviously rising, issues with banks, you haven't seen people take keys. Are we at that point? Did we miss an Did you miss an opportunity?
We didn't personally miss an opportunity because, like I said, when we provide leverage loans, they're moderate, and we build in headroom to work with sponsors, and actually we've always seen it as a collective problem. Are there bad leverage loans in the market? Of course there are. Are there banks holding on to more credit funds that don't want to do anything? Of course they are. And I think we're bad in the UK in taking our medicine. In respect in the US, I think they clear up the problem quickly and just say, look, they've gone bad, let's start again, let's reprice. And I think there's an issue with exits because of valuations. I think a lot of people appreciate valuations. Buyer and seller are still disconnected. And most people in this room will say we're 15% off, but no one's going to call it. Until someone starts calling that, there's a problem.
Yeah, I want to come back and ask your fellow panelist on that situation. Maybe one final question for you. When you're looking out kind of this year and next, anything changing in terms of your underwriting? Are there particular sectors that you're, very excited to back? Are there sectors that you're more cautious? You talked about, maybe not underlying GPs not taking all that financing.
So I think one of the key things we look at in, say, the sponsor world, we look at sponsors, not only track record in performance, but track record of supporting company through troubled times. That's important to us. When do they stand up? Now, a sponsor's never going to follow bad money. Let's be clear. Just because you've got a sponsor doesn't mean they're going to do a bad deal. It's not going to happen. That's not fair in their LPs. And I think banks have to be realistic about that. But there are certain sponsors that are a delight to work with in a trouble situation, say, yeah, we will resolve this and we will help you and we'll work together. There are other sponsors who will say, no, it's your problem, deal with it, you put the leverage in. So different scenarios. I think regarding sectors, we're sector agnostic, apart from the sectors you wouldn't talk to your mum about. But I think otherwise, it's interesting what Rachel Reeves said was, around the public services, public sector person trying to pump money into the economy and stuff. So you think actually should that be good for leverage if you've got public contracts in place? Is that good? There's some resilient sectors out there that will just keep on going. But I think every company, there's winners and losers in every sector. So I know that's a politician's answer. So I can't say this is the sector I'm backing. But I think there's multiple opportunities out there.
Yeah, fair enough. Cyril, I think I've known you the longest, maybe 2 decades, seeing each other at AGMs and always such a great source of information. And given you're a senior managing director at Ardian, how many years have you been at Ardian now?
I joined in 2007, so that's...
So more than a few. And your transition from looking at funds to secondaries and now to co-investments, and particularly continuation vehicle single assets. Give us what does that look like with your underwriting with, you have, tariff headwinds, geopolitical, just supply chain, basic blocking and tackling. What does that look like in terms of your ability to allocate to these CVs?
To the CVs in particular, yeah. So basically, we always face kind of changing environments. So that's not totally new. Effectively, that's troubled times. We have been through different kind of crises. So paradigm have changed quite significantly. Doesn't change drastically the way we assess assets. I mean, of course, due diligence evolved. They always tend to evolve. The way we see CV is a bit particular. I do co-invest, I do CV, and for me or for us, the CV asset class relies at some point on continuity. So you would need to find something where you can extrapolate what has happened in the past as much as possible to the future, which means that you need as stable things, as much continuity in the equity story. So to answer my fellow panelist question, we are generalists, but you need to rely on long-term trends. You need to make sure that effectively you don't have disruption risk. So effectively tariff, complicated logistic chains, cyclicals, and things like that are more complicated for CVs. But the advantage of CVs is that we have the proof of what has happened in the past, and you are very much plug and play in the new story with the same team, with the same everything, which provides some comfort and hopefully some downside protection if you play the rules right.
And is your role to be a price taker, or are you setting the price?
So we are setting the price more and more regularly. I think that's where we are good at and well equipped to do. So on our side, we see really the CV and it is structured that way as a kind of combining the skill sets of our secondaries team, which is, as you know, operating for almost 3 decades as well, is one of the largest and probably the strongest in the world, and which has a deep experience in running those processes and has strong connections with GPs. That's very important. We have strong access to deals and angles. And that's as well the co-investment team, which is doing the underwriting and things like that. So, sorry, I lost track of what
I was at.
landing point was.
Maybe just another question. We talked about valuations and being a price, maker in terms of setting that price. Are you seeing that you're able to now set prices at a discount to NAV? Because before, if you had a continuation vehicle, it was kind of like, you're doing this at March NAV. We're not going to take, or it was a very small single digit. We're starting to see in our CVs that we look at, or that have an option to sell on behalf of the GP. They're getting a little deeper NAV discounts too. Is that because?
We probably see a bit more discount in the market. That's fair to say. I would say that the kind of layer of the market we are really looking at on our side, which is we really are hunting for quality and we want all the stars to be aligned, and we have a kind of very strict kind of set of criteria we want to find. We don't think that's too much of a discount play. Of course, we will adjust pricing and so on, but contrary to some other segment of the secondary business, it's very much about crafting the deal around our own concerns, making sure we are picking the right assets and the right GPs. That's always a match between a GP and an asset, and that matters most than a potential short-term trend.
Then the discount, it's all about the value creation in Ardian. I want to come back to exits and liquidity against this macro backdrop, but Tim, over to you. I mean, you've been at Phoenix for a while. You're a partner there. You're specializing in tech-enabled business services and in impact. You have a complete, I guess, temperature over the UK lower mid-market, and obviously very excited about Rachel Reeves' comments on growth, I imagine. But how are you seeing kind of some of the headwinds in the UK market against your existing portfolio and what you're looking for to deploy capital?
Yeah, I think if we take the first one, i.e. impact on the portfolio first, we're investing in small companies, SMEs typically making 50 or less of revenue. Candidly, the first step for the portfolio impact team at Phoenix is making sure that we understand and the companies understand what's going on in those companies. So we have an entire team dedicated in the early stages of an investment to making sure we have the right financial systems in place, the right KPIs and dashboards, such that these companies, which have largely hitherto worked generally with a cash balance and a revenue figure, understand the impact that, for example, inflationary issues, supply chain issues are having on their performance. I'd say in the last year or two, there's probably 3 particular focus areas that we've used to help the companies combat some of these margin reducing inflationary elements. A real focus on understanding pricing and then enhancing pricing. A real focus on go-to-market strategies. Just taking one of our companies, Dufresne, for example, a data consultancy had never gone to market previously through a channel strategy because it wasn't big enough. With our capital and backing, that's definitely an option. We've spent a year researching how to do it. We've now done it, and it's reduced go-to-market costs and enhanced gross margins. So that's great. In terms of supply chain disruptions, there's lots of different types of supply chain disruption. Probably the most relevant thing in our portfolio has been a high-value logistics business called Ava. They're a massive user of air freight, commercial air freight space. That's a market that's had volatile pricing and been disrupted significantly due to geopolitical events. The way they've come at it, which I think is slightly different to just a close analysis of the cost base, is to do a really careful market segmentation and understand the customers that have the least price sensitivity and focus on them. It turns out those customers are perfectly willing to pay twice as much for the service as long as the service levels are high. So you can use a charter aircraft, for example, instead of commercial space, higher service levels and higher margins. So that's actually been a really valuable tool for us as well. But to be honest, the starting point for many of our SMEs is really understanding what's going on and understanding the impact of the macro on the micro, if I can put it like that.
Absolutely. And I guess one final question for you. You have a kind of a forward insight when you look at your pipeline or order book for some of your service businesses. Are you seeing decisions being delayed or taken longer, or are you starting to see that kind of crystallize?
So I may be a slight contrarian here, but you kindly prepared us for a question about sort of, I think you described it as silver lining in your when we talked a couple of days ago. Our own perspective on that is that a year ago, before the general election last summer, there was significant disruption in decision making for proper corporate and public sector projects. So I'm involved in a handful of portfolio companies. One has a lot of public sector exposure, particularly to defence, and a couple have quite a lot of enterprise exposure. We found the start of last year, pre-election and candidly 3 months post-election, quite tricky from a decision-making standpoint. Our own perspective across our portfolio, just 15 companies, is that decisions are starting to be taken, capital is beginning to be unlocked, and certainly in the public sector, I mean, Rachel Reeves mentioned defence earlier, there is now a tailwind of decision-making leading to investment.
Okay.
It's early stages, and perhaps not everyone is seeing that, but that would be my answer.
Well, I call them silver linings. I know Richard called them green shoots. So I want to stay on the green shoots
Yeah.
comment and liquidity because, and I believe what Richard said, that's the key to kind of getting this engine kind of keep on going and the underlying growth that we all need in terms of driving this outperformance. So maybe, Mo, a question for you. One way for liquidity or recaps, are you seeing the pipeline, various different GPs at your door saying, I want to recap this, I got to send money back to LPs? Is that a trend and a push for the final 3.5 months?
We're seeing it slightly differently in my world because I look after the fund space. So we're seeing a significant increase in NAV, where GPs are coming to us and say, look, we've got a lot of good portfolio companies, not necessarily go put money back to redistribute to the LPs, but actually keep on investing. I think what's happened in this period is investment horizons have moved out, and I think that's a permanent feature now. I think we'll see longer exits even going forward. And so what we've seen is significant NAV deployment with certain funds from mid-market to true global players, and using that really positively within the portfolio for accretive purposes, whether M&A, further capex, and just waiting for the right time. So they've had the discussion with the LP and saying, look, we're going to delay this a couple of years, but we're going to deliver a lot more value. Let's just see how this plays out. We think we've got good companies. Why would we be forced now to sell? It doesn't make any sense. Yeah. So I think the exits will continue to be slow. I don't think 26 is going to be the year that actually liquidity comes rushing back. And no, I don't.
Oh,
I don't.
just.
I'm sorry.
Anybody else upset with that?
Sorry. I'm not the Grim Reaper. Sorry.
No, but I mean, we've lived through it this year.
Yeah, I think it'll be slow. I think you'll probably see 27. I think it'll take times funds to get back into the fundraising cycle, and you'll have to prove it as well. But I don't think it's a bad thing, actually, extending the investment lifetime. I think it's actually long term. I think it's a very good thing for the industry, and it's forced innovation, which I think is very positive.
I guess as long as you can continue to deliver, 400 or 500 basis points against a public market index. You're kind of up against that IRR, obviously, on the longer hold period. Cyril, you mentioned something really, that we believe too, these continuation vehicles, perhaps midlife investments are less risky because it's the devil you know. But when you look at the peak of, you're starting kind of that rocket ship of CVs, kind of 2020, 21, that's kind of a 4 or 5 year hold. When do we get a real exit? Are you seeing any of that? And how are you thinking? Because a lot of the CVs, they haven't been through that real exit test.
Yeah. No, that's true. I mean, CVs are like the rest of the M&A market or the rest of the PE market. They need the exit effectively. So when we look at a CV, we always look for exit optionalities. Mm-hmm. So we really want to see the asset being able to exit whatever the IPO market conditions are, for example. But that's fair to say that some of the older CVs are now reaching the maturity where they are supposed to exit. We see some CVs of CVs, which is...
so CV 2.0?
CV 2.0. So
great for evergreen funds.
That's something which needs to be carefully monitored, of course. Yeah. But yeah, there is no magic around that. Even if we think that, of course, in every kind of complicated market, the most solid asset, the best assets are probably the easier to exit. So we see across our own portfolio of CVs interesting exits already. So we have quite a kind of a good DPI on our CV portfolio. And we have actually exits in the pipe as we speak. So the market does exist. And once again, I think because this market is quite qualitative by nature, yes. The best assets are likely to be the easiest to exit in a complicated environment.
Yeah. We have in our portfolio, sometimes people say, but you're buying it at 6 times, 8 times, which is, value. But it's now become very bifurcated, the quality. People are chasing resiliency and quality. And Tim, to that point, how are you finding kind of this exit market against, maybe a UK market that, maybe people have more of a gray view of versus?
I think it's a choppy M&A market, and many private equity funds, as a result, are thinking quite carefully about deployment. I guess there's two answers to the question. One is that in the lower mid-market, if you are selective about subsectors and the niches that you're investing in, and you've done a good job of building value and building real infrastructure and scalability in those platforms, generally speaking, my view is there is still a good exit environment for the top quartile of assets, if I can put it like that. And I think everyone aspires to have them. And in a given portfolio, the proportion of top quartile assets determines the quality of the returns. So I think it's embedded in a way in the investment strategy right from the start of the fund. Inevitably, and everyone will do this in their own way, we also have a very structured process of making sure that problems, which we call the dirty dozen, by the way, because it's dirty, because there's always stuff that comes out that we don't expect, but there has to be a thorough coverage of preparation and a reduction or elimination in the number of surprises or unknown events that come out through an exit, because you're trying to tell the story of growth, and you've got to be very careful about making sure that if you're presenting an asset which is clean, great infrastructure, well invested, that's actually what you've produced. We take that very seriously, as I think most of our peers do.
All right. Well, thank you all very much for your perspective and time. And Mo, I really hope you're wrong about next year, but I may owe you a bottle of champagne. Anyways, thank you all very much.
Thank you.